Hey everyone, welcome to The Explainer. I'm host A, and today we're unpacking an earnings report that is honestly a massive head scratcher. We're digging into the latest 9-month financial results for Lion Asiapac Limited. This is for the period ending March 31st, 2026. And if you just skim the headlines, the numbers completely contradict each other. So joining me to decode this mystery is host B, our resident financial analyst.
Hey, thanks for having me. I'm excited to dive into this one because you're totally right. On the surface, this report is a total paradox. It's the exact kind of statement that'll instantly panic an investor if they just look at the top lines without digging deeper.
Exactly. And that brings us to the big, glaring question. How on earth does a business grow its revenue by 45%, but still report a net loss in the millions? I mean, as an investor, when you see a massive spike in revenue, you're usually popping champagne. But a net loss of almost 6.8 million Singapore dollars, that immediately sets off alarm bells.
Oh, absolutely. It's a huge red flag at first glance. But it's actually the perfect example of why you can literally never just trade off a headline. Today, we're going to peel back the layers of these financials, because the truth hiding behind the panic is actually a really fascinating story of a company just cleaning house.
Okay, so to make sense of this, you kind of have to understand how accounting rules force a company to report things. You basically have to slice the business right down the middle into two distinct buckets. The first bucket is continuing operations. Think of this as their everyday active core business, the stuff Lion Asiapac is actually planning to keep doing. The second bucket is discontinued operations, and that represents a piece of the business, a subsidiary in this case, that they literally just got rid of.
Right, so if I'm an investor trying to figure out if this company is a good bet for tomorrow, I really need to zero in on what they're actually still doing, not what they just threw out.
Precisely, you hit the nail on the head. And what's really wild here is the sheer scale of the growth in those continuing operations. When we strip away all the stuff they sold off, their core revenue didn't just grow, it skyrocketed by a massive 45% compared to the same 9 months last year.
Wow. Okay, so that is not just some minor seasonal bump. That is incredibly aggressive growth. We're talking about hitting nearly 18.9 million Singapore dollars in revenue, up from around 13 million. That changes the entire narrative right out of the gate.
But where is all that cash actually coming from? Because Lion Asiapac has their hands in a few different cookie jars, right?
They do. And breaking down their revenue by segment reveals the exact engine driving all this growth. So, their investment holding segment brought in 0 revenue, which honestly is totally normal for that kind of division. Then you have their trading segment, dealing in stuff like steel consumables and mining equipment, and that brought in a respectable 3.6 million. But the supply of roofing solutions segment, that pulled in a jaw-dropping 15.28 million Singapore dollars.
Unbelievable. So the roofing solutions business isn't just doing well, it's the absolute powerhouse of the company. It is literally carrying their sales.
And the proof of that powerhouse is right there in the profit statement. When we look strictly at those continuing operations, that core roofing engine we just talked about, the company actually turned a really healthy profit. They posted a positive net profit of over 715,000 Singapore dollars.
Exactly. And just to give that a little perspective, during the exact same period last year, those continuing operations lost over $480,000. So they have completely flipped their daily ongoing business from a painful loss into a very solid profit.
Okay, but I gotta stop you there because we have to pivot and address the obvious. The core engine is highly profitable, it's growing super fast. So where on earth is the multi-million-dollar leak? How do we go from a healthy core to a headline net loss of 6.8 million?
Right, and for that, we have to turn our attention back to that second bucket we talked about earlier, the discontinued operations.
All right, let's address the elephant in the room, investigating the massive net loss. Well, the consolidated statement of profit or loss points right to the culprit. If you look at the line for loss from discontinued operations net of tax, there's a massive 7.56 million Singapore dollar hit just sitting there.
Oof, that is a brutal number. I mean, it essentially swallowed up all the profits from the roofing business 10 times over.
It really did, but again, you gotta understand the context of what a discontinued operation actually is. Think of it like this. Imagine you own a rental property, but it's got a caved-in roof and absolutely terrible plumbing. It is just constantly draining your bank account with repair bills every single month. Eventually, you might just decide to sell the house at a big loss, right? purely to stop the bleeding.
Yeah, for sure. So you take a really painful giant hit on the day you sell it, but the silver lining is that next month you don't have to pay those repair bills anymore.
Exactly. You stopped the leak. And in this case, Lion Asiapac sold off a subsidiary called Compact Energy. It was a one-time, finite financial event. Let's actually just do this simple math on the sale to see how it works out. They sold Compact Energy for a purchase price of about 14.86 million Singapore dollars. But on their accounting books, the value of its assets, plus some tricky foreign currency reserves they had to factor in, were valued at roughly 21.7 million.
Ah, gotcha. So it's pretty straightforward. They sold it for less than the accounting value of its assets. 14.8 million minus 21.7 million gets us to that roughly $7.4 million loss on disposal.
You got it. It's a really ugly entry on the income statement, no doubt about it. But it's a one-off event. It does not mean cash is actively bleeding out of their daily operations right now.
All right, next up, the treasure chest. Let's look past the profit and loss statement.
Okay, so they took this big one-time hit to shed some dead weight. But honestly, a loss of that size still makes me a little nervous. Is the company actually safe right now? To figure that out, we need to look past the profit and loss statement and crack open the company's treasure chest, their balance sheet. And let me tell you what a treasure chest it is. Lion Asiapac is essentially sitting on a financial fortress. Their total cash and cash equivalents stand at an incredible 46 million Singapore dollars. Meanwhile, their total liabilities, meaning every single debt and obligation they owe to anyone, sit at just 9.3 million.
That is staggering.
They literally have almost 5 times more cash sitting in the bank than they do total debts. And verifying that directly on the balance sheet is honestly just reassuring. Seeing that 46 million in cash padding their accounts really puts the whole situation into perspective. Even with that huge multi-million-dollar accounting loss from selling off the subsidiary, the underlying foundation of this company is incredibly undeniably secure.
It's a massive safety net. It means they have all the capital they need to weather any storms, invest even more into their booming roofing business, or jump on new opportunities without having to take on a bunch of expensive debt.
Which brings us to the outlook, evaluating future risks and opportunities.
So putting our investor hats on, what does all this actually mean for tomorrow? We've solved the big paradox of the earnings report, but how should we evaluate their trajectory moving forward? Let's balance out the risks and the opportunities.
Yeah, balancing those two sides is absolutely crucial. On the opportunity side, things are looking exceptionally bright. They have a core roofing solutions business that is growing revenue by 45% and is highly profitable. Plus, as we just saw, they have an absolute fortress of a cash reserve to fund future growth.
But we got to keep it objective. There are definitely still risks. For instance, while they did sell off one big losing subsidiary, their trading segment is actually still operating at a loss. If we think back to the segment breakdown earlier, the trading division lost about $169,000 over this 9-month stretch. It's a manageable risk, but it's still a leak they're going to need to plug or turn around. So let's boil it all down for the key takeaways. Number 1, despite the scary headlines, the company's core revenue is growing rapidly and it's doing so profitably. Number 2, that massive multi-million-dollar net loss, it's an isolated, one-time accounting hit from selling off a subsidiary to stop future bleeding.
Exactly.
And number 3, the company's balance sheet is incredibly cash positive, providing a super secure foundation. So really, that terrifying headline loss was just hiding a surprisingly healthy core business that finally shed its dead weight. Perfectly said. It just goes to show why you always have to read the fine print. Thanks so much for joining us on this explainer. Keep looking past the headlines, and we will see you next time. Over to you for the sign-off.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.